Brad Williams, Frugal Finance Investing. Whenever you buy and sell stocks, you're going to have some tax consequences. This video is about cost basis. What is cost basis? Cost basis is selling an investment. Typically has tax consequences. Figure out whether you need to report a gain or can claim a loss after you sell. You need to know the cost basis for that investment. For stocks and bonds, the cost basis is generally your purchase price for the security, including reinvested dividends or reinvested capital gains distributions, plus additional costs such as the commission or other fees you paid to complete the transaction. This information is usually provided on a confirmation statement sent to you by your brokerage firm after you purchase the security. You're responsible for reporting your cost basis information accurately to the IRS, in most cases by filing Form 8949. Understanding cost basis could help you steer clear of costly consequences. For example, let's say you bought a stock investment for $1,000 and sold it for $1,500 2 years later. Now let's say the stock paid dividends $100 in 1 year and $300 in year 2, and you reinvested these dividends, making the adjusted cost basis $1,400. Your taxable gain would be $100. $1,500 minus $1,400 instead of a much higher $500, $1,500 minus $1,000 if you didn't factor in the reinvested dividends. While this is a relatively simple example, computing cost basis can get complicated, but you're not totally on your own. Brokerage firms, mutual funds, and others are required by law to report the cost basis of shares purchased by investors. But be careful here. They're not always accurate. If you're doing multiple trades in the same stock, in a short period of time, the computer systems generally don't match. For example, let's say in January, you bought Target, you shorted Target, then you bought back the short, then you sold the long position, then you rebought the long position, then sold the long position, then shorted the Target, then bought it back, and you did this multiple times in a day. You need to match those. Even though that's short term, still going to be a cost basis involved. I've found that the computer systems mismatch this stuff, and they'll match the first trade in January with a late January trade, where you do the in and out trade on the same day. Be sure to check your trades. Brokerage firms' responsibilities. The IRS provides FAQs about the cost basis information brokerage firms and other financial institutions must provide. For example, brokerage firms must report cost basis in the type of capital gain, short-term or long-term, on Form 1099-B for the sale of stock, bonds, options, and other securities, depending on their purchase date. Investors should receive a copy of any 1099-B from their brokerage firm by February 15th from the previous year. Review this information as soon as you get it. Check that the amount of cost basis your firm reports to the IRS matches your own records, and if the amounts differ, contact the firm immediately. There may be situations where a firm isn't required or able to provide a cost basis for sale, such as if the securities you sold were purchased or transferred from one firm to another prior to reporting requirements published in 2008. If you have questions about what sales are reportable by your brokerage firm, contact your financial professional. Many firms also have a section on their website explaining cost basis and the specific cost basis information they provide to their customers. 4 recording tips. While brokerage firms have cost basis reporting obligations, it's still important for you to keep good records of your transactions. Follow these tips. Keep an electronic or printed copy of your trade confirmations showing how much you paid for specific shares. Keep track of stock dividends or non-dividend distributions you receive, because they may affect the cost basis of your shares. If you purchase stock of a company at different times and prices and can adequately identify the shares you sold, their basis is the cost for those specific shares. If you can't determine exactly what shares you're selling, tax rules generally require you to calculate a gain or loss as if you're selling the earliest acquired shares, sometimes referred to as the first in, first out method. If you receive the securities as a gift or through an inheritance, you might have to find out what the fair market value was when it was given to you or the previous owner's adjusted basis. IRS Publication 550 offers detailed guidance on how to calculate the cost basis under different circumstances. Also, sound practice to consult with a tax professional when computing and reporting a gain or loss. The bottom line is that The IRS expects you to maintain records that identify the cost basis of your securities. If you don't have adequate records, you might have to rely on the cost basis that your brokerage firm reports, or you may be required to treat the cost basis as zero, which could mean owing more in taxes. For this reason, consider checking whether you have cost basis information for securities you want to sell before doing so. Comment if you don't understand the cost basis, how to keep your reporting in line, or how to complete Form 8949. Brad Williams, Frugal Finance. Thanks for watching. Hope that helps. See you soon.